Trading Nut, episode 49.
We like narratives as human beings. We love stories. We love a theme. We love a linear relationship from one thing to another. And this comes out all the time. If you listen to any financial publications, financial news, financial television, they will often say the market is up because of...
The market's going to do something. Your job is not to fight it.
The market never, ever runs away. It's always there.
That personal diary of trading will make you a much better trader than...
I could be right about the direction, but wrong about the trade.
Don't focus on the monetary side.
Trying to make too much money on a trade is what I have seen killed every trader.
Your losses offer you some of the greatest insight you can find into your mistakes.
Relax, learn the process.
Candlestick pattern trading is a freaking trap.
Don't be in a rush to become a millionaire.
Let the market tell you what the market wants to tell you.
This podcast is not financial, trading, or investing advice of any kind. What's up, traders? Welcome to the 49th episode of the TradingNut podcast. And you know what? I've just realized last week's episode was a year. It was basically just over a year since we launched on the 5th of September 2018, the TradingNut podcast, after it was rebranded from the 52 Traders podcast. What you can tell from that is there's probably been about 4 weeks where you haven't had an episode because we had 52 weeks in a year, and we skipped a couple here or there just to give myself a little bit of a break here and there. So, folks, we've done 1 year of I was going to say 52 traders of TradingNut podcast. So I want to thank you guys, the listeners, for making this, well, giving me motivation to carry on with this and really bring as much insight and market knowledge to you listeners out there as I can each and every week with interesting traders and what they have to share. And I'll tell you what I've liked most about this is jumping on the YouTube videos after I do my little podcast interview, getting the guys to walk through a price chart. Some of that stuff is absolutely gold. So if you haven't seen that yet, jump onto the YouTube channel and take a look at the mini courses. I think I've called the mini courses over there. So there's a playlist already. Go and have a look at the old ones. We've actually got one coming up with this episode today with David Keller. Now, David's a stock trader from the US. Look, we've had a couple of stock traders recently, but what you find is that, you know, if you're looking for long-term investments and you're not a stock trader, but you trade something else, Forex, futures, whatever, then there's some great advice in here for where you want to, I suppose, how you want to maybe approach investing. So, guys, we've got a fantastic interview here with David in a second. But before we do that, I just want to go over a quote that I saw today and leave you pondering it before we get into it, because I thought it was quite good and it relates to us traders out there. So here it is, and it's from the late Mark Douglas. So it goes like this. There are only two types of traders with the potential to succeed. The first type are those who are consistently profitable and seek fine-tuning. The second type are those traders who are absolutely desperate in their desire for consistency because they've yet to achieve it. Everybody in between doesn't have a chance. Where the determination lies, the way can be found. So, guys, where are you on that scale of seeking consistency? Are you already there, profitable, looking to fine-tune, or have you got a very strong desire to be consistent versus anything else? And I suppose being determined is the way forward. So, where are you guys? If you're not on that spectrum, then what does he say? You haven't got a chance. All right, so on that note, let's get on with the interview with David. Enjoy. Got David Keller here on the show from Sierra Alpha Research. Now, David, welcome to the show. So you're over there in Seattle, is it Seattle, Washington?
It is, yeah, Washington State in the Pacific Northwest here.
I always get confused with the Washingtons and where it sits in the US.
Yeah,
so,
of course.
So today we got a slightly, I suppose, different interview from what the listeners might be used to here on TradingNut. I'm not going to go through all my questions in the sequential order that I sometimes do. We're going to jump around a bit because you've got quite a bit of experience in the, I suppose, the world of the financial markets, and it's unique to what a lot of my other guests typically bring to the show. But before we get into that, I want to start off by learning a bit about you, how you got into the world of finance, trading, and starting way back in the beginning and moving forward through your career.
Yeah, thanks so much. And Cam, listen, it's such a pleasure to be on with you. I've enjoyed listening to some of your previous interviews. So thanks for what you're doing with TradingNut. I'm enjoying it.
Brilliant.
So my background, I have the very, I guess, non-traditional background. I actually studied music and psychology as an undergraduate at Ohio State, in the Midwest of the U.S. And it's funny, at the time, I did not realize it was a great educational platform to launch into a career in finance, but it's actually served me pretty well. And the reason is because music, if any of your listeners that are musicians, there's a very mathematical relationship to sounds and what sounds good and combining different notes and different patterns. And so for me, studying patterns in music and learning conducting and things like that actually helped me the first time I saw a price chart and saw that I was looking at all of the indicators and seeing what patterns emerged and using my knowledge of market history to know what was going to come next. The moment I saw that was something you could do, it just clicked with me. I felt like I was somehow trained for it as a musician. And then psychology, I've used a great deal, studying just how people think. And so a lot of my career has been aimed more toward the behavioral finance side, really thinking about how people think and unpacking some of the, decision-making challenges that people have with their investments. And so I actually entered right into the financial industry. I started working with Bloomberg in New York. And so I had a couple roles, but I settled in as the technical analyst there. And so covered accounts in North and South America and essentially traveled around to institutional investors, buy-side firms, sell-side firms. So, a currency trading desk in New York down to a two-person investment advisory shop in Detroit, and then down to Bogota, Colombia, to talk with equity investors there, and so got to learn a lot about what caused people to make buy and sell decisions. Using charts, using technical analysis, using investor sentiment, and then from there in 2008, I actually moved up to Boston, Massachusetts, and took on a role as a director of research at Fidelity Investments. And so ran the technical research team and one of the other analyst groups. And so we worked with actually all the equity portfolio managers that run the equity mutual funds and essentially help them identify buy and sell decisions across the equity universe. And in covering equities, we sort of covered all different asset classes. And it was really more long-term investing, thinking about long-term trends, secular movements in assets. But, in the day-to-day movements, it was a lot about the short-term fluctuations and how they relate to the long-term trends. And then about 2.5 years ago, I actually switched gears and launched my own firm called Sierra Alpha Research. And I work with institutional investors and financial advisors, and actually more some educational content for individual investors, thinking about, sort of that combination of behavioral and technical inputs, why we make certain decisions with our investments, how to, sort of correct for some of the challenging decisions we can make, but then also using technical analysis as an actionable toolkit to identify opportunities and manage risk. So that's my quick summary of where I've come from.
Cool. And look, I mean, I think way back when you were in Bloomberg is an opportunity that a lot of the guys listening to the show, including myself, would love to have had, where you got to go and meet all these, different key players in the financial markets. I mean, can you tell us anything about, like, for example, some of the institutional firms that you visited? Any insight that you had? Any little stories or nuggets?
Yeah, of course. So one that I've loved telling people is one of the first times I went down to some of the FX trading desks in New York City. So it's one of the larger trading desks, and if you've never been there, there are these warehouse-sized rooms filled with just rows of desks with people trading different assets, different currency pairs. And so I was walking down the currency desk, and my role at the time as a technical analyst was to meet with all of our clients, which were all, the traders, and help them incorporate charts more into their decision making. So see how they were using technical indicators and help sort of refine, make better decisions, maybe tweak their process a little bit. So as I'm walking down meeting people, I all of a sudden noticed this one person's desktop. This guy's sitting there, and I look, and he has 4 screens in front of him. So just this cockpit of information. And as I'm looking, he probably had 60 to 70 different technical indicators on his screen at the same time. I'm talking the most complicated, busy, all these colors, all these lines. And I'm looking at this, and I sat there for like 5 minutes watching him trade. And I'm thinking, how is he making sense of this? This is amazing. So I finally introduced myself. I say, hi, my name's Dave. I'm a technical analyst. What you're doing is incredible. Can you just, give me a sense of what you're doing? How are you doing this? And he said, yeah, I have absolutely no idea what any of that stuff means. He said, but the head of the desk walks by and says, look at that guy. He's all over the markets. He's on top of it. So it was a great lesson in that if you want to impress people with how complicated you can make things and all the eye candy, all the busyness, you can make things way too complicated. But in terms of actually making money with charts, with technical analysis, or I would argue with most of your investments, simple is what works. And having something that's simple, that's repeatable, that's robust, I think stands the test of time. And so I've used that as a reminder not to overcomplicate and not to put so much in front of you that you're paralyzed and you can't make good decisions.
And so was this guy actually, like, when you were watching him trade, I mean, was he doing anything or just sitting there looking at the screen? I mean, was he placing buy and sell orders within that 5-minute period?
He was. And what's funny is as I unpacked what he was actually doing, there was a small corner of the screen with 1 or 2 indicators, and that's what he was actually looking at to make his decisions. The rest was just up there as the window dressing. So when anyone walked by, they would be, overwhelmed with how on top of things he was with all the signals and such.
Right. Yeah, okay. All right. And what about some, like, did you learn anything out of all that in terms of sort of fundamental, like, man, if people knew this, then that would really unlock a lot of the game for them?
It's a really good question. And, I was very fortunate, as you suggested, I mean, getting to see a lot of different types of firms and people running different, money in different ways, from large institutions, running billions of dollars down to small operations. And, and even people like, at the top of Tudor Investments, met Steve Cohen, and, getting to sit down with guys like that and actually ask questions about their process was really, really, formative for me. And, if there's one takeaway I had, and I think what led me to the value of thinking about behavioral finance is that as much as some of those really tenured, really successful investors, you feel like they have all the answers and they don't have any of the issues that you might face as an individual trader. I will tell you 100% of the time that the people that are managing a lot of money and people that have a lot of responsibilities are struggling with a lot of the same things that you might be managing your own portfolio. The number of zeros might be different, the responsibility level might be different, but in the end, it's all the same decisions that they're making. And guys like Steve Cohen and others that I met with, I think the simplicity with which they looked at price action and just tried to think about how are they trying to win, and then just repeat that as much as possible. So for someone like that, it was mean reversion and looking at short-term movements and selling high and buying low, but finding a consistent way on a certain time frame to do that in a repeatable fashion. That was the game for him. And it wasn't trying to complicate it by being something you're not. It was focusing on your plan, focusing on how you're trying to win, and then make that a consistent routine. And so, with a lot of my clients now, we use the word routine often because it's everything from what's the first thing you look at when you log in the morning and bring up your account or bring up, a charting platform, whatever it is. What's the first thing you look at? What's your process for going through the steps to get sort of on top of what's happening? I always call it the morning coffee routine. And I find that those investors, the guys that I met with that I really was impressed with their performance and their routines, that's what they had. They had a solid, consistent routine and they followed it religiously. And so, with a lot of my clients, we try to use that sort of thinking and help build good habits that you can consistently do. That's what I found brings investors success consistently.
So when you're on these floors and going through these institutions, I mean, did you pick up any sort of, especially with your background in behavioral finance, did you pick up any sort of, I suppose, psychological traits that were being, I suppose, shared through what people were doing on the floor, or was it just like a normal office?
Oh.
Well, you can't really tell.
Yeah. So two things I would say. On a trading floor, especially, and again, you compare that to like a hedge fund, which tends to be very secretive. It was very difficult at a place like a Tudor or something to really understand what all different groups were doing because it's all behind closed doors, all kept very private. But on the trading floors, you had the benefit of hearing really the open outcry system at work. I mean, hearing traders and salespeople interacting, hearing people call out levels, and you could feel the mood rise and fall based on what was happening with the markets. And also, I mean, I was able to spend time on the trading floors in Chicago, so the CME, the CBOE, the options exchange, and the CME, the futures exchange, and you could feel the volume rise and fall as the volatility increased and decreased. And it's unfortunate. I think for a lot of people, they miss that now that a lot of the floors obviously have gone electronic and we've gotten away from that. There's a signal that was there, just feeling that momentum and feeling, panic, increase and decrease. I think we're missing that. And again, a lot of the technical approaches I think people try to use correctly are trying to capture that, quantify that in a way that maybe, would replace what you had seen from the crowd. But if there's one personality trait or something that I found a lot, I would probably bucket it mostly under overconfidence, which is, especially professional investors, you are taught from the beginning to have an opinion, to take a position or make a recommendation, and then pound the table, dig in your heels, and your job is to convince others that you're correct. And so as a result, when it's proven by some market action or whatever that position is no longer correct, you've convinced yourself that you're right. You're sort of overconfident. You have this this bravado with which you're approaching your role or approaching your book. And as a result, you tend to overplay things. You tend to stay way too long in something that's no longer working because of that confidence, or what I would say the overconfidence. So, one of the ways that I try to help people avoid that, especially professional investors, is, having an evidence-based process. And what that means, you would argue everyone should have that. Whereas instead of defining your position, defining your process based on your preconceived notions, your preconceived biases, what you want to happen, what you wish would happen, really focusing your process on gathering evidence, gathering information. So, having a dashboard of sorts, having a process with which you can identify when the environment has changed and have as emotionless as possible of a way of signaling to you when you're on the wrong side of something. And the more quickly you can recognize that and take action, that's what I think prevents you from, more significant risk and significant loss.
Okay, well, I'm going to jump back just a tad, and then we'll jump forward again to what you've just talked about. Because I want to ask quite a detailed question. It's something you might not remember, but so you mentioned that these guys are calling out levels. Now, did that seem to be? And it's probably really testing your memory here, but was it like a bunch of people calling out different levels, or was it like one person calling out a level that everyone was following, or how did that work?
Well, I think it's a really good question, and I would say so this is maybe early 2000s that a lot of those experiences would have happened, going on those trading floors, and I would say at that point, this was early after decimalization had happened in U.S. equities, so it was still kind of being tested, and there was a lot of changes. The euro had just come out at the end of the 1990s into 2000, so that was still kind of evolving. So the dynamics of the market were still sort of changing. This was maybe up to and after 9/11. So it was a very volatile period in terms of rapid change in the structure of the market. And so I think a lot of people were still very old school in terms of thinking of specific price levels. And if you think about it, if stocks are trading on eighths, there aren't that many levels. So between $70 and $71, there are only 8 points that you can be at, and then you're at the next level. Now with decimalization and then sub-decimal trading, right, sub-penny trading on stocks, specific levels I found are less and less meaningful. And so when I'm talking to investors now, we talk less about a price level. Something's going to hit this specific price level, and then that has meaning. It's more support ranges or resistance ranges, right? There's a range at which you would expect buyers and sellers to come in, or expect there to be an inflection point, because things are moving at such small intervals that they can fluctuate a lot, second to second and even sub-second. So at the time, yes, I remember people, scrambling for levels. At what's the line in the sand that we should be looking for? And so most, desks that I saw, there would be a desk analyst, someone who was a chart aficionado, right, the chart guy, who would be able to look at the short-term chart, look at the 1-minute candle chart, and be able to identify, yep, this is the level, look for this, and if it breaks that, we're done. I found more and more, I think that you have to become a little softer in terms of specific price levels, in my experience, just because of the nature of how things are trading now.
Okay, cool. And so jumping forward again into that evidence-based approach, have you had any experience with, giving this advice to people and sort of seeing them try and implement it but not do a good job?
Certainly, Cam. None of my clients, I can assure you, no. Right. No, it is very challenging, and it's funny. It's no coincidence that the first step in any sort of 12-step program of recovery starts with admitting that you have a problem. And I would say that for most investors, most traders, especially individuals, and professionals as well, I think that's what is most challenging, right? When you think about decision making, when you think about what might be causing you to make a poor decision at times, you have to first admit that you're not perfect and that you're imperfect and that you are not capable of making 100% the right choices. And, again, if you think on the institutional side, a pretty capable institutional investor is correct directionally on a stock just over half the time. We found, over time, 53 to 55% is pretty good, which means 45 to 47% of the time you're going to be wrong. And so the game is about recognizing that you're not, and it's not just decision making, it's also just that the market will move in a way that's contrary to how you're positioned. But that is something you have to be aware of and accepting of. And I would say it's a spectrum of certain qualities or certain behavioral tendencies that people are more or less willing to sort of get rid of. I would say one of the toughest is confirmation bias, which many of your listeners might already be familiar with. But if not, it's essentially this, right? So if you're thinking of the U.S. markets, recording this at the beginning of September, the market's sort of been range bound for the last 3 or 4 weeks, and now at the upper end of that range. But the question is, is this a new leg down we might see for the S&P, or is this the beginning of a rally back to the previous highs? And that's the real question. But what you don't want to do is say, I am bullish on stocks, and I think we're going to go back up to the highs from the end of July. And then you start to look at the evidence, and anything that is bullish and confirms your bullish view, you sort of, acknowledge that. And anything that's more negative or more contrary to your position or your view, you sort of mentally push it aside. And as a result, all you do is you've had a preconceived idea, I'm bullish, and then all you're doing is looking at evidence and mentally acknowledging the things that support your view, and all you're doing is doing what you would have done anyways. You're not really paying attention to the evidence. So what I try to get people to do, and I would say the way you fight that is by making it very manual. I actually get people to write it out on a piece of paper as much as possible. Here is your checklist. And once you have answered these 8 questions, you have earned the right to decide whether or not this market or this position or this stock is bullish or bearish. And it's, from a technical perspective, what are the moving averages doing? What key price levels are we near? Where are we at or near a 52-week high or low? What are other stocks doing? And sort of this list of questions, how is it doing relative to its peers? And once you've answered those questions, then you look at that as a mosaic and you take the weight of that evidence and say, is this evidence I've just looked at bullish or bearish? Okay, it's bearish. Now, how does that compare to how I'm positioned or what my view is right now? And do I need to make some changes to my view or changes to my position? And it's very hard for people to do that because going into the trading day, you know how you're positioned, you usually know what you want to happen or what you think might happen. And as a result, it very quickly clouds your ability to bring in the information. So that one is probably the toughest one to unpack. And again, my goal with people is try to make it manual, really write out, here's what I think, here's what I'm seeing, and then conclude an opinion or conclude a position after that gathering of information.
So the key tip here, guys, is to write it out, to write out what you're seeing. And then look, this makes so much sense when I sort of reflect on some of the stuff I've done in the past, like where I've had a position and it's gone against me, and this is like where I've been moving stops and all that sort of stuff. Not good trading whatsoever. But I obviously had a bias in one direction, and then I was seeing all this evidence that was showing me that it was going in the opposite direction, yet still the bias was so strong that I was trying to come up with like anything that was going to stop this price move, and it just didn't happen until you get to the point where you just can't face it anymore and you close out, and then it obvioly retraces back in your direction, as we all know.
Yeah, so Ned Davis, who some of your listeners might know, he's a long-followed analyst, runs a firm based out of Florida here in the U.S. And when I met him years ago, he shared at a dinner the quote, "All large losses begin as small losses." And that's such a great thing to keep in mind. If you can, again, the key to preventing a climactically large, painful loss destruction of capital is to limit it when it's still a small loss. And so, as you mentioned, when you put on a position, just the simple exercise of saying, here's my position, and if X, Y, Z happens, I'm going to revisit it. No questions asked. It's happening. Setting an alert, setting a trigger, a trailing stop, and just automating it from the beginning. That simple task can alleviate a lot of the challenge that you just described, which is, trying to justify a losing position as it's getting more and more painful, right?
Yeah. Look, I can just picture those wicks sort of going against me now and hitting levels and going, oh yeah, that these wicks sometimes fail, and yeah. Anyway, so what about other? So that's the confirmation bias,
sure.
Which I think is a good one for everyone to remember, and to remember to write stuff down to make sure you haven't got a bias on one direction or another. Are there any other biases out there that might be affecting investment and trading decisions?
Absolutely one. I would say another one that comes to mind immediately based on the story you just shared is endowment bias, or the endowment effect. And if you're not familiar with this, it's essentially where, and listen, I should qualify these by, it's very easy when you start talking about behavioral biases and decision-making to think that we're all messed up and it's hopeless. And I would say it's not. There are actually some things that humans actually do very well. And maybe if we have time, we can talk about that. But so I don't mean to make it so negative that this is hopeless and that you're wired to make all these bad decisions. But there are obviously certain things that we run into, and endowment bias is the next one. And that's essentially where we treat things we own differently than we treat things we don't own. So, a stock that is in my portfolio, I own Home Depot, which is a home improvement retailer here based in the U.S. And now that I own that stock, I think of it differently. I don't think of it as a company. I don't think of it as a series of price data. It's mine. It's my baby, right? It's something that I own. And as a result, I am hesitant to get rid of it when I probably should, because it's mine. How could I get rid of Home Depot? It's been such a great stock for me. I've had such great luck with it. I've had great returns. Why would I sell it now? It's, this happened last time. And so that's not what you want to do. You want to think of your positions as not something you own, but you want to think of positions as something you're renting, right? So when you buy a stock, you're not owning it, you're actually renting it. Now, to be totally clear, you do own the stock. You have responsibilities as shareholder. Totally fair. I don't mean to dispute that. But in terms of how you think about your positions, you should think of it less as you own it and more like you rent it. And the reason why I say that is because by renting it, you can very easily close that out with no harm, no foul, no love lost. Get it off your plate and move on to some better opportunity. What you don't want to do is think of your positions and having an emotional attachment to them, because when they start performing poorly, you resist the urge to sell them because you have this pull to hold on to things way too long. And the same, that's another reason why a lot of times people will hold on to positions way too long, even after they've been winning. So instead of taking profits when it might be an opportune moment, we've reached a price target, we've hit resistance, something that would tell you maybe I should take some of it off the table. We hold on to it because it's been so good. And again, it's my baby. I can't get rid of it. And you want to, again, going back to an evidence-based process. Look at the data, look at the evidence. And if you see indications that you should be making a change, don't be afraid to do that, and don't use an emotional attachment to be a part of that decision.
And what about, so is that more aligned to things that you're buying as opposed to, or going long on versus shorting?
I think you could do it both ways. And again, we tend to phrase it in the form of a long position. It's something you own, but I think also with the short position, right? So, or even with the currency pair, you're married to that position, you're married to that point of view, you're married to that specific, outcome. And then when the evidence tells you different, you decide not to take action because you're sort of married to that. You're wedded to that. You own that position or that idea. Yeah.
Okay. Yeah. So it's almost like if you're having, you've had 4 losers and you finally get one good winner, and you're like, this is the trade I've been after. I own this trade. That's where you get into trouble, where you forget that this is just one of many trades that you're going to be doing over your trading career. Right.
That's right.
Yeah. Righty ho. What about, so you mentioned a couple of others, so you got one more bias there?
Yeah, the next one that I would say that comes to mind that we haven't spoken about is the narrative bias, which is, I would argue, one of the more commonly seen ones, and it's sneaky because it it comes in a lot of ways. It's not just with your investment decisions, with your trading, but it's also with all the decisions you tend to make in life. And it goes back to how we're wired. And narrative bias is essentially, we like narratives as human beings. We love stories. We love a theme. We love a linear relationship from one thing to another. And this comes out all the time. If you listen to any financial publications, financial news, financial television, they will often say the market is up because of XYZ. You know, banks are down because of the yield curve. Markets are down because of inflation worries. It's up because of China trade talks. There's always a direct relationship attributed from one movement to one fundamental or macroeconomic or technical factor. And so that narrative is what we sort of develop in our mind. Either someone tells us through financial media, here's what's happening and why, or we create our own narrative. Okay, the yield curve is flattening. That means this is what's going to happen to interest rates. This is what's going to happen to banks. This is what's going to happen to my position in Key Corp. And all of a sudden you develop this whole narrative. But the problem with that is that nothing like that happens in a vacuum, right? The markets are not a simple mechanism with a couple things in line that move perfectly. It is a complex mechanism, right? So there are all sorts of things that could drive an asset price at any moment and any day and any week. And while there are China trade talks happening, there's also the yield curve and there's Brexit and, you know, just pure sentiment and all of these things that could compel different people or different combinations of people to buy and sell on any given day. So if you get married too much to a narrative, you will be caught off guard when that narrative does not play out correctly. So what you want to do is don't get too focused on a specific linear outcome. Don't, you know, if you read financial news and it tells you X is happening because of Y, I think you always want to have a healthy dose of skepticism to that. And again, I think that's one of the values if you're using charts as a trader, if you're looking at price data, because you cannot deny the price, right? This shows you how people are coming together, buyers and sellers coming together and agreeing on a price at a certain moment. That is not restatable. That is undeniable. That is what's happening. And so in terms of measuring sentiment and understanding relationships, the charts are what will tell you what the relationship is and how that's changing. The narrative is what will become clear well after the fact, right? A year from now, we will know why gold went up in a certain way and how Brexit impacted the pound and other markets. All of that becomes clear in the rearview mirror. But looking forward, it's all about the data. It's all about, you know, for me, it's about the charts and the price action and what's moving. And the why is something that you can speculate on, but that narrative, that why, tends to be much more clear down the road. So for your listeners that are more, you know, trading oriented, which I think most of you will be, then I think, you know, a healthy focus on the price itself and on the movements in the price and on the relationships between different markets and less on a particular narrative, I think is going to serve you very, very well.
Yeah, I mean, as you mentioned gold there, like just even this week, somebody said to me, like, gold's going to shoot to whatever it was. And I was like, after it had massive run up already. And then I was like, oh, okay. Because I can see it going down. Anyway, and then it goes down, and then it's like, there it go, it went down. It went down like 200 points. And then it was like, hang on a sec. I thought you said it was going up. He's like, this guy was a good trader. And he's like, oh, yeah, I meant it was going up. It was going up in the long term, not tomorrow. Right. And it's like, and I made a note to myself. I'm like, do not listen to anyone because you've got to do your own work because it's just, you're going to get yourself in trouble. Even if they do know what they're talking about, you don't know in what context.
Yeah, that's right. And I think, and to be clear, I do a lot with financial media and go on television and things. And I think there is a place for things like that in your process. I don't mean to say turn it off and don't pay attention to others, because I think there's a lot to be gained from learning how other people are approaching things and how they might be positioned and why and how they're thinking about, positioning. So I think there's value there, but I would never think of it as a recommendation. Oh, I should do this because gold's a safe haven. Yep, it should be going up right now. I would take that as a way to consider your own process, right? How are they going about it? How are they coming to that conclusion? Interesting. How does that relate to how I might be positioned? How might I approach this market a little different? What signals could I look for to validate that? And if you do it in the right way, I think it can be additive to your process for sure.
Now, what about sort of merging or melding together the technical analysis and behavioral finance to manage risk in your portfolio. I mean, what would you recommend?
Sure. So, for me, technical analysis has always been, less about, identifying the next home run, identifying the next 10 bagger, the next stock that's going to go up exponentially. And it's more about managing risk. And again, I think that goes to a lot of the behavioral biases we've talked about. A lot of the challenges you have with behavioral finance or decision making is being caught on the wrong side of something because you're not able to take the emotional angle out of the picture, and you're not relying on the data. So what's great about charts is that you can have very clear signals, very clear levels at which you agree to revisit something, right? So, you're positioned a certain way. And so for me, when I'm looking at a market and I see, all right, the S&P 500 potentially breaking out, if this happens, then it is a bullish configuration. I have to be long. But if it hits this level, if it goes back to this point, this previous low, this support level, this moving average, whatever your discipline would be, that's the level at which the trigger occurs, right? And so it's not an emotional decision. It's more of a quantifiable, repeatable decision, right? Based on the price data itself. So for me, behavioral finance, the idea of behavioral decision-making and behavioral concepts like that are the way of describing why you make decisions in a certain way. In my opinion, technical analysis is a way to practically apply that knowledge and bring greater discipline to your investment process. So, identifying clear signals, clear levels at which you may need to revisit a current position.
Okay, I'm gonna slightly divert the conversation and just want to get your view. And I ask all my guests this: get your view on cryptocurrencies at the moment. What are your sort of high level thoughts?
Absolutely. So, as a behavioral finance aficionado, I have to say that the growth in cryptocurrency investing and trading, and the more and more people that are involved in it, is fascinating from a behavioral perspective, because it's, most markets, when you're looking at equities, you're looking at the chart of Microsoft. There is a deep fundamental data on this company. There's a lot of understanding about the long-term prospects and the growth and windows and the different product lines and how that all has evolved. So the technical inputs, looking at the price data, is just one piece. You also have this much bigger piece about the company and the management team and the earnings growth and trajectory and so forth. With cryptocurrencies, you don't have a lot of that, right? There's very little ability to make a fundamental argument, but besides, again, big picture, the changes in payment processing and blockchain and how that technology obviously could become, could proliferate. That's a whole separate thing. But in terms of valuing a cryptocurrency based on fundamental data, it's pretty limited at this point, and arguably could always be. So as a result, it is more of a pure read on investor psychology. It is a, I think future books on manias and panics and crashes will include, Bitcoin as an example of how things evolve and how quickly they can fluctuate and so forth. So for me, I think the value in it is that it is can be a very technically oriented market, which is pretty cool. In terms of where I see it, for me, I'm always looking at how something like Bitcoin, if it's the widest, most widely followed price series, where it is relative to where it's been. And the more price data that has come out, the more we've seen how this market evolves, the more we can see how certain price levels have meaning and have memory, and where people might be more and more interested or less interested in it. And for me, I tend to keep things very simple. So I tend to like markets when the trend is going higher. I tend to not like markets where the trend is going lower. And you simplistically measure that based on the highs and lows, the peaks and valleys in the price. When the market goes higher, are we achieving higher highs? Or when the market goes lower, are we achieving lower lows? And just looking at that simple relationship over time will tell you overall the trend that we see in these markets. So something like Bitcoin, and again, the series I've tended to look at, the GBTC, which is a Bitcoin trust, which isn't a perfect proxy for Bitcoin, but not too bad in terms of seeing the price levels. And from a long-term perspective, you've seen this rounding bottom, you've seen this accumulation as the price has appreciated. But in the last couple of months, sort of entering in the summer here in the U.S., it's been it's hit a resistance level and it's sort of come down and now range bound and sort of at the middle middle end of that. So you would want to see a higher low, which we have not seen since last June. So that's what I would be looking for, a rally and then some sort of higher low, which shows you that there's accumulation happening. And then I think there's potential for further upside there.
So I'm going to throw this question at you. I know you haven't had time to prepare for it, but I think with all your knowledge and experience, you might be able to answer it. And it's something that keeps popping up here and again, or now and again on the show. So the question is pretty simple. Is the market manipulated in your view?
Ooh, that is such a simple question which begs a very complex answer, Cam. That's a tough one.
It is a tough one.
It is, is it? Yeah, boy, I don't even know how I would say that. So my short answer would be yes. But the long answer would be yes, but it doesn't matter a ton. And I'll try to explain it. Is it on certain timeframes? I would say the shorter of a time frame that you operate on, you are more and more participating or subject to the movements of all the things that now are affecting short-term price movements. So a lot of algorithmic trading and the fact that, prices break levels and then accelerate and you see a ton of volume come in, you can see when there's programmatic buying and selling that comes in there. And I think the good news is there's value there because once you recognize key levels and you recognize when some of those systems may come in, I think there's opportunity there because there's movement. And as an investor, as a trader, the more volatility, the better, because without volatility, there's no real price action to benefit from. So as a technician, as a trader, you want the more volatility, I would argue, the better because it gives you movements to measure. So as a short-term investor, I'm not a day trader, but if I was, I would be concerned about that impacting. It's no longer a bunch of individuals or institutions, trading shares. You are playing in a field that is not level, and there are a lot of people with, faster data and faster execution that you will probably have. I would say looking at longer term investing, I would argue that a lot of that short-term manipulation or short-term dynamics and how they've changed, I would argue, probably is better for long-term investing because I don't think it impacts it negatively. It provides plenty of liquidity, and overall, I don't think it's reflected in the long-term trends. Those decision-making, those biases that I've mentioned, I think are still rampant on that longer-term time frame. I would also say then, I guess maybe one other qualifier is, remember for me as a technical analyst, it's all based on transparency. And so the more transparent, the more liquid, the more, widely followed a market is, you could arguably have less advantage using technical analysis because there is more of a level playing field. The markets are more efficient. There's a lot more players with different motivations in place. If you look at less liquid markets, so more emerging markets and even more so frontier markets, this is where markets are less liquid, less transparent, and I would argue that behavioral biases tend to be more rampant because it is more like the U.S. or more developed markets may have been decades ago, whereas much more of a level playing field, and I think individuals have a lot of potential opportunity to disrupt or to identify mispricing and identify gaps between the value of things and where the prices are at.
And how did you, I suppose, when did you sort of get to the point where you'd say, you'd answer yes to that question? What was there any sort of moment in your life where you were like, you found out some information or somebody told you something, or is it sort of accumulation of things?
Really fair question. It's probably been a process over time that I've maybe become more to recognize that. But for me, I think it's the first time that I learned what percent of, heard greater and greater percentages of trading that was being done, institutional trading that was done algorithmically. And when there were hedge funds doing, high frequency trading and things like that, that's one thing. But when you heard of larger trading desks, larger firms, trading greater and greater positions using programs and not using discretionary trading by humans, for me, that started to convince me, okay, there's only so many ways that you can develop a program to trade off of the VWAP or something like that, which means the chance that they are overlapping, becomes much greater. And I think we're going to see a lot of challenges as a result. I think that's probably the moment when I started to hear over 50% of trading is being done programmatically or algorithmically, that's probably when it triggered for me.
Cool. Well, look, so how active are you with your own trading?
Right. So for me, very limited. Only so my role is really as a strategist and coach because the upside of my career working at some of the larger firms, and Fidelity was the largest firm most recently. Fantastic exposure to people and their processes, but incredibly limited in terms of how I could trade my own capital. So I've often tried to limit how much I'm tinkering things. So I actually keep it relatively boring for my own personal capital and try as much as I can to use my insights to help clients make better decisions.
Cool. I'll ask some of the questions I usually ask at the end of the show.
Sure.
So what would you recommend a retail trader spend the next month mastering? What would it be? How could they go about mastering it?
Ooh, that's such a good question. For me, the trick or the process I would ask people to master is sort of going back to the checklist idea that we talked about. I'm a student pilot, so I've spent a number of years trying to learn how to fly airplanes. And the first time I went up and saw how thoroughly you reviewed all the mechanical systems in an airplane, also the communication and everything else, by the time you actually fired up the propeller and got in the air, you felt pretty confident that everything was working very well. And the reason why that works is because you go through a very disciplined, systematic process that's the same every time. So what I would challenge your listeners to do is think about when you're actually making a trade, when you're putting a position on, when you're having an opinion and putting something into play, what are the steps that you're actually taking to make that decision? How are you documenting that? How systematically are those? And can you upgrade that process? Is there something that you can add there to do it? But I think if you think about your decision making, your decision tree, and again, the list, the checklist that you follow, I bet there's some gaps on there that you could focus on.
And the last question, I don't really want to leave it off on this final question here, but this is a question I ask all my guests. So what was the worst ever trade that you've had?
Cam, I was hoping you wouldn't ask that. That's
There's always a good story.
It is a good story, and I hate it because again, as a behavioral expert, right? The worst thing you don't want to do is sort of admit when you were wrong, but it happens. You know what? Sadly, I have plenty of things I could refer to. The one that probably comes to mind is, again, I've not traded as much as I've been a strategist and have been, advising investors on what to do. And I would say, for me, it's the middle of 2013 and remaining or becoming bearish on the markets and remaining bearish way too long. And if you know your market history in the U.S., right, you had the rally, the tech bubble into the late 90s. 2000, March of 2000 was the peak. I actually started in the industry in June of 2000, so it came in right afterwards. So the beginning, my first year or two as an investor were the bubble collapsing, 9/11 when I lived in New York, into the 2002 low. And I mean, it was a crazy, just a fascinatingly difficult period. But as a result, I've been skewed more to the bearish side mentally because that's how I was when I was looking at charts for the first time. Everything was kind of rolling over. And so then the same thing happened as we rallied up 2004, 5, 6, fantastic. 2007 hits, we top out again or right about at the same level. So when we get to 2009, 10, 11, 12, 13, we revisit those highs. I'm thinking, no problem. This is the next peak. It's lining up with resistance. Here are all the signals that were overextended. And I very quickly developed a bearish thesis based on similar patterns, which what worked in 2000 and what worked in 2007. And so for me, when that was wrong, I knew about behavioral finance well before that, but that really solidified the importance of it when I saw how wrong I was there and remained wrong, in the summer of 2013 as we continued higher. And as we kept breaking to new highs, I realized that my process needed to be focused way more on the evidence and identifying systematically what trends are in place and using that as a framework for decision making. So I have some long-term trend following models, intermediate-term trend following models that I developed using moving averages, and a lot of them came from that period, and it was an acknowledgement that I turned bearish when things actually still held up very well. And so, for me, I think hopefully one of the best things I did was try to go back to that period and look at the macro level, but also at the stock level. A lot of stocks actually looked still pretty good, even though the market, might have been extended. And so, for me, it really helps solidify how I want to think about trend following going forward. But thank you, Cam, for bringing up a painful period in my career.
Don't worry, I've heard worse on the show. I've heard much worse. Right now, so the last question of the show, before we wrap up. Now, I'll give you a choice, actually. You can either leave the guest with, I suppose, a technique that they can use to help with their psychology, or perhaps that, I suppose, the one piece of advice that you'd recommend anyone sort of take home after listening to this.
Oh, thanks for that question. The one thing you could take away, hopefully this has been a good, discussion on how you think and what causes some of the decisions you probably know in your, as I'm sharing stories, think about your own trading and where you might have, held on to things too long or things like that. If there's one thing to take away, I would ask your listeners to think about what's the very first thing they look at in the morning. And I cannot overstate how important that is. And to explain why is, one of my advisor clients, and advisors in the U.S., if you're not familiar, right, more long-term oriented, thinking about asset allocation, big picture, helping people prepare for retirement. But a lot of them are trading in the short term to sort of help, generate positive returns so people can retire gracefully down the road. And one of my clients was trying to do more long-term investing, was trading too actively and was trying to minimize some of that in one of her accounts in particular. So I asked her, all right, well, tell me what's your process? It's the beginning of the day. What are you doing? And she said, well, I'm looking at, the short term. Basically, it was a short term market movement. It was, this morning, what are stocks doing up and down? And I said, okay, hold on a second. So if you're long term, what should you be looking at to really orient yourself to the long-term trend? And she's like, well, probably something about the long-term trend. And I said, well, that's right. And we completely flipped it. So the very last thing she was doing was looking at the long-term trend in equities versus bonds versus metals and all the different asset allocation decisions that she could make. We moved that to the very beginning of the process. So the very first thing she did every morning was look at the long-term trend in the big assets. So everything afterwards was primed with that perspective. And as a result, she naturally became much more oriented to the time frame that she was trying to operate on. So again, if a lot of your traders are shorter-term investors, I would just have that question. What's the very first thing you look at? And is it the right thing to help put you in the mindset to be able to make the better decisions for the rest of the day?
Yeah, good advice, good advice. Now, before we wrap up, what's the best way for everyone to get hold of you?
And thanks again, Cam. This has been really fun. I hope everyone's enjoyed listening to the conversation. Two ways I would say. So I write a blog called Market Misbehavior, and you can find it at marketmisbehavior.com, where I try to unpack some of these themes about investor decision-making, behavioral psychology, and a dose of technical analysis in there as well. And then on Twitter, I'm at DKellerCMT, and happy to engage people there as well.
Brilliant. Well, look, a big thank you to David for sharing with us today. Everything we've discussed here, along with all the links that he's just mentioned, will be in the show notes. So to find them, simply jump onto TradingNut.com and search for David in the search box. Until next time, I wish all my listeners trading happiness and success. All right, folks, hope you enjoyed that interview with David. Now, look, if you want to see what we jumped on and what he showed me on the Zoom chat we had, then head over to the TradingNut YouTube channel. There are links in your show description. So if you're on your podcast app on your phone, scroll up or click on the description button, link, whatever it is, and you should find links to the YouTube channel there. You'll also find links to the TradingNut website, where you can get access to a $9.99 interview from the 52 Traders podcast on the house. All you've got to do is jump over to tradingnut.com. You'll find a short little survey to fill that in, and then you get your credit that you can spend in the TradingNut members area. Now, last but not least, there's also funding options available. If you're looking to get funded as a trader, then head over to the site as well, and you'll find some various funding options for futures, Forex, and stocks are coming soon as well. So guys, check that out. And last but not least, if you are interested in automated trading, I've got the Robot Traders Club, I've got the Robot Builders Club. I'm planning to do a webinar any day soon now, so stay tuned for that on the email list. But for now, you can jump on there. We've got some strategies in the lab where we're testing, so if you want to check that out, $7 in the door, and you can have a look-see around. All right, folks, until next week, have a great trading week, and I'll see you in the markets.